Hi, I'm Jimmy. In this video, we're going to look at the balance sheet. So we're going to run through the entire balance sheet. We're going to look at all the individual lines, pausing to focus a bit more on some of the key numbers that come out of the balance sheet. So the first question to answer is, what exactly is a balance sheet and how can we use it? Well, this is a sample balance sheet. Now, not that it matters for this example, but this is Microsoft. So this is Microsoft through the most recent fiscal year. And basically, what the balance sheet does is it looks at all of the different accounts that they have at a single point in time. So while the cash flow statement and the income statement look at a period of time, so from 2023 to 2024, or whatever it is, the balance sheet is looking at the balances of their different accounts at a specific point in time. So on that day, what was the exact balance? And the trick here is that this balance sheet is broken into essentially three different sections: assets, liabilities, and equity. And the reason that they call it a balance sheet is that these numbers must always equal each other. They must stay in balance. Assets has to equal liabilities plus owner's equity. Okay, now let's jump in and look at the asset side of the balance sheet. And we're going to go through each of these individual line items fairly quickly, just so we can get an idea of what they are. Again, pausing at the most important ones. Now, we're actually taking this snapshot from the Investors Grow website, where we're working on videos for each individual line item. So if you're curious about a specific line item in more detail, you can find all the information over there. I'll leave a link to that in the description below. But for now, as far as assets go, you can really break it into two different sections: current assets and non-current assets. Basically, current assets are near-term assets, anything within the next 12 months. Non-current assets are longer term, anything longer than the next 12 months. So for us, we're going to focus right now just on the near-term assets so we can see what those look like. These are all current assets. Okay, now the first thing we want to pay attention to is the date. So notice here we have three different dates. Now, on the Investors Go website, we actually go left to right. Some websites go right to left, but in this case, we're going left to right. So that's important to pay attention to. Just note which data point you're looking at. So in our case, we're looking at the far most right column here is the most recent numbers. These are quarterly numbers. Now, the reason I would take quarterly numbers if I'm analyzing a company is, again, the most recent data point is the most interesting one, especially when it comes to analyzing, where they currently stand. So their fiscal year, in this case, is fairly old compared to where they currently are right now. So a lot of times the balance sheet makes more sense to go with quarterly numbers. Even if you went with annual numbers for the income statement and cash flow statement, stick with quarterly numbers for the balance sheet. The most recent quarter will be the most up-to-date numbers. Okay, the first one here is fairly simple: cash and cash equivalents. That is exactly what it sounds like. Either cash that the company actually is holding, or perhaps it's cash sitting in a checking account or a savings account, something like that. You can see here, Microsoft has about a bit over $28 billion. So they have a lot of cash. Then right below that, we have short-term investments. These are investments they're considered short-term investments would be one, they're due in the next 12 months, so they can convert it easily into cash in the next 12 months. Maybe they own US treasuries, or maybe they're in a short-term CD or something like that. Something that you could take quickly and get over to cash. So it is essentially cash. Well, add those two up and you come up with the following line, which is cash equivalents, and short-term investments all combined. So fairly simple. Okay, then we've got a line item called net receivables. So net receivables is actually a combination of a couple different things. One is accounts receivable. Accounts receivable would be money that owes, in this case, we're looking at Microsoft. So when other companies owe Microsoft money, that's an accounts receivable. So Microsoft has a database system like Azure. Well, pretend that there's a company that's using that service, using Azure as their database. So every month they have to pay Microsoft money. Well, maybe Microsoft has issued a bill to them and they have 30 days to pay it. And then in the middle of that, the balance sheet is due. Well, that money is owed to Microsoft. So that is an accounts receivable. Now, technically, the difference between accounts receivable and net receivables, which is what we're showing here, is that let's imagine you thought one of the companies wasn't going to pay you. Well, that would be a doubtful account. If you didn't think that they would pay you, net receivables is what's left after that. So companies owe Microsoft right now $51.7 billion. If they didn't think $1 billion of that was going to get paid for some reason, well, that net receivables number would be down. Now, for curious, in the case of Microsoft, their accounts receivables and net receivable numbers in the most recent quarter was the exact same. So they think everybody's going to pay. Okay, then we've got inventory. Now, inventory can actually be broken into three different categories. Depending on what company we're analyzing, if we look at the footnotes of that company, they could break it into one of three categories. There's raw materials, work in progress, and finished goods. So finished goods are products, we're looking at Microsoft, the Surface laptop or Surface tablet, whatever it is. They're done, they're ready to be sold, they're sitting on their shelves. That's in inventory under finished goods. Work in progress, well, on the date of the balance sheet, well, surely they're in the middle of building some laptops or whatever devices they're building. That would be under work in progress. Raw materials, obviously, the raw materials that they will use to create those products. So inventory, depending on the company we're analyzing, this could be an interesting number to do a deep dive on. Okay, then we have other current assets. Now, this could actually be a lot of things. Other is kind of one of those catch-all phrases on financial statements that it could end up being a lot of different things. And again, you could find the information in their footnotes. But it could be things like, let's say, a prepaid expense. So maybe they owe, they have to pay monthly for something and they pay for the whole year in advance. Well, if they've only used a month of that year, the other 11 months could land in here. It's an asset. It's something that they've already paid for. They've already outlaid the cash, but they haven't quite used the benefits of that. Then we've got total current assets. This is a simple one. Add everything up. Total current assets, all of the assets that the company has to work with to operate their business over the next 12 months. This is the current assets as of the date of the financial statement. What do they have that they expect to be, let's say, liquid in the next 12 months? Okay, so now we'll jump in and go back to the full asset side of the balance sheet. But now, this time, we're going to zoom in the long-term assets. These, again, are not too different from the current ones, but these are ones that go out beyond the next 12 months. Then we've got property, plant, and equipment. Property, plant, and equipment are exactly what it sounds like. If they own property, if they own land, if they have the buildings on the land, if they own, trucks and things like that, if they buy laptops or servers, perhaps they're putting up a server farm. This is Microsoft, perhaps they're putting up a server farm. Well, that would fall under long-term assets, assets that are expected to return something to the company for more than 12 months, after 12 months. Property, plant, and equipment is where that number would fall. Now, one important thing to keep in mind about property, plant, and equipment is property, plant, and equipment, at least most of it, gets depreciated. Land doesn't get depreciated, but everything else does. Buildings, trucks, things like that. Now, the way that works is, imagine a company bought a truck. They spent $100,000 on the truck, and they think that this truck is going to last 10 years. So let's imagine the $100,000 divided by 10, $10,000 each year. So in property, plant, and equipment, which is the value of it, well, next year, because 10% of it, or in this case, $10,000 would be depreciated from it, well, $10,000 would come out of property, plant, and equipment that year. So the value would gradually drop, in theory, to try to keep up with the real value of what the actual assets are. So that's one way that they try to do it. By the way, that $10,000 would end up on the income statement as an expense. So this is one of those that a company could kind of play with the numbers. They say, hey, you know what? It's not going to last 10 years. This truck's going to last 100 years. So instead of depreciating $10,000 a year, we're going to depreciate $1,000 a year, and expenses would look much smaller. Follow the line, expenses look much smaller, profit could look larger. So this is something you want to kind of pay some attention to when you're analyzing the balance sheet. Then we've got goodwill. Now, goodwill is a bit of a unique asset in that goodwill comes up on the balance sheet when a company makes an acquisition. So let's pretend Microsoft were to make an acquisition of another company. Well, basically what they do is they take the tangible assets of that company minus the liabilities, and whatever's remaining is what in theory is the fair value of the company. So they take that fair value. Now let's pretend assets are $2 billion and liabilities are $1 billion. Well, the company's worth $1 billion. Well, what if Microsoft pays $1.5 billion? If they pay $1.5 billion, well, the $500 million that they paid extra would land in the goodwill category. If they paid $5 billion because they really want this, maybe there are certain patents that company has or certain intangible assets that company has. Maybe they paid $5 billion. Well, this number would go up by $4 billion. Now, unlike property, plant, and equipment, which we saw was depreciated, well, that doesn't happen with goodwill. Goodwill, on the other hand, gets tested for impairment. So each year, the company would go ahead and test whether or not the goodwill that they have on their balance sheet is still what they think it is. It's still valued at what we thought it was. Now, if you've ever heard people say that goodwill is kind of the, let's say, the value of the brand, this is what they're talking about. What they're talking about is they're going to buy a company, but they have a really good brand. You take their assets, you minus their liabilities. Well, that's the tangible side. That's a tangible value you're paying for. Anything you pay above that is perhaps the value of their brand. But what they are not talking about, just to be clear, they're not talking about the value, in this case, of Microsoft's brand. Microsoft cannot say, you know what, our brand is worth more today and increase this number. There's a mathematical formula that explicitly explains why this number goes up or why the number goes down. So something to keep in mind. If you see a big jump, they made an acquisition. I guarantee it. If you see a drop, they probably wrote something off. Now, flip side is if they were to sell an asset, they were to sell, let's say they sell up a division of their company. Maybe that was a division that they acquired previously and goodwill had gone up. Well, when they were to sell that division, the goodwill would leave their balance sheet. So that's another way it could decrease. Okay, now we got intangible assets. So these are assets that you can't physically touch. Think about it something like if you're writing code for a website. So there's actually two different phases of this. Phase one, you're coming up with the idea, you're kind of spitballing how it could work, putting a little bit of money into it. Well, that money gets expensed right away. That doesn't hit intangible assets. Phase two is after you've kind of come up with a plan, now you're working on the final development. You're getting ready to deploy it. And in theory, you're going to use this code or whatever the intangible asset is, maybe a patent, something like that. You're going to use that for the business's future benefit, in theory, to generate free cash flow down the line. Well, at that point, that's when the numbers get added to intangible assets here. So the numbers that will be added to this would be things like the salaries that you pay the developers to write the final code. Maybe if you use a third-party company, those costs would be added here. And then those numbers would be amortized later. So as time goes on and, if you pay more people, the number goes up. Well, on an annual basis, you would amortize it. So you gradually decrease the value of those numbers. So that's what intangible assets are. Then we've got goodwill and intangible assets. That just totals up those two subcategories. Then we move on to long-term investments. This is investments. This is kind of similar to cash, except it's not due in the next 12 months. That's really the only difference. So imagine that a company like Microsoft has a lot of cash. They're sitting on, we saw before, they're sitting on big amounts of cash. And they got some others. Maybe they buy another company's bonds. Maybe they buy longer term government bonds, and they intend on holding those bonds for, let's say, 2 years or 5 years or 10 years. Well, those would land in long-term investments. So long-term investments can be a lot of different things. It could be investments in other companies. It could be investments in perhaps private companies or bonds or government bonds. It could be a lot of different things. And again, generally, in the footnotes of the company, they will explain what that is. But this is out of the long-term assets. This is the closest one that they will likely be able to get to cash if they needed to. Again, assuming what it is. If it's an investment in a private company, that could be a long-term investment, but that's not very liquid. So if you are looking at this as cash, it generally makes sense to dig into it, read the footnotes in the financials to make sure it is actually convertible into cash at some point. And we've got tax assets. Now, tax assets, unlike what we saw in the short-term asset side, tax assets here are long-term assets. So in theory, money owed to them from the government after the next 12 months. Now, we could see in this case, Microsoft is showing zero, but it's possible that perhaps they have some benefit coming from taxes, from some government agreement that they made or something down the line beyond the next 12 months. Generally, tax assets are going to fall into current assets, but this category is here just in case. Okay, now we're sliding down to another kind of catch-all one that is really, it could be so many different things. The thing to keep in mind here is if you see a big jump in this number, the other non-current assets, if you see a big jump in any other number, go look at the financials. You got to get the actual financial report to see what it is. They will explain what it is, especially if it's in another category. And they will explain what it is and how they got there. And in this case, we know, if nothing else, we know that it's going to be an asset, something that will benefit the company beyond the next 12 months. Then we've got total non-current assets. Basically, add up this whole column. That gives you total non-current assets. Well, add that to the current assets, and that would give us the total assets number down here. So total assets, we know, is going to equal total liabilities and owner's equity. So for now, let's jump over and look at liabilities. And again, just like we saw on the asset side, you could break this out into two different sections. Here, we have current liabilities. So basically things that the company owes over the next 12 months. Okay, then we've got accounts payable. Accounts payable is sort of the opposite of what we saw before on the asset side, accounts receivable. Accounts payable is it's what they owe, what the company owes for, let's say, everyday expenses. So let's say they order some of the raw materials that they're going to use to build some of their products, but they haven't paid for those materials yet. So perhaps the quarter ends and the balance sheet date comes and they have 30 days to pay those, and it's halfway through, they haven't paid it yet. In their mind, it kind of probably makes sense to wait to pay it. Why not hold that cash a little bit longer? So they hold it. Well, that sits on the balance sheet on the liability side as an accounts payable. Then we've got short-term debt. Short-term debt are loans or debt or notes that are due in the next 12 months. So perhaps this is interest payments that they have to make on bonds that they issued. Or maybe their bond is maturing in the next 12 months. All of those numbers would land in short-term debt. This is a very important number. If you ever hear somebody say, hey, can their assets cover their debt? Generally, we're talking about debt like short-term debt and long-term debt. But short-term debt, we're not usually necessarily talking about accounts payable. That's a little bit different thing. That's more of a day-to-day expenses, whereas debt is something they borrowed money. If they don't borrow money, this number will be zero. And we've got tax payables. Tax payables, so we saw tax receivables on the asset side. That is money that the government owed them. Well, tax payables, it's money that they owe the government, whichever government that they're paying the taxes in. A big multinational company like Microsoft, where they do business all over the world, they probably pay taxes all over the world. So this is money that they owe to some governments during the next 12 months as far as taxes go. Okay, now we've got deferred revenue. So deferred revenue is money that they've already collected, but they've yet to provide the service. So they have Microsoft Azure or Microsoft Office, right? Let's pretend I went out and bought a 1-year subscription to Microsoft Office and I pay for it up front. Well, let's pretend they book it each month. So I pay them, I don't know, whatever it costs for the year. Let's say it's $120 a year, so $10 a month, just to keep the math simple. $120 a year. Well, after the first month, I've already paid them for the full year. I've already paid them $120, but they've only provided the services for 1 month. So 120 out of the 120, they've earned 10. That would be on the revenue. The other 110 would sit in unearned revenue. So it's basically money that they've collected, but they've yet to provide those services for. A lot of companies that have very subscription-heavy business, you'll see this number be quite large. Then we've got another catch-all number here, other current liabilities. This is liabilities that are short-term, pretty much any liabilities that don't fit cleanly into the other categories. Again, if we want to know specifically what a specific company is classifying as other current liabilities, we'd have to check the footnotes, and it could vary wildly. I mean, it is all over the place as to what could land in that category. Generally, it's a number that doesn't fit nice and cleanly into one of the other buckets. Then total current liabilities, exactly what it sounds like. Add all these up. This is the total current liabilities. All liabilities due in the next 12 months. That's the primary thing to keep in the back of our mind. Okay, now we jump back to the broader balance sheet, and now we're going to zoom in on the longer term liability side. These are either called long-term liabilities or non-current liabilities, anything beyond the next 12 months. Okay, now a lot of these we're going to be familiar with because we just saw a lot of these in current liabilities. It's the same thing, just beyond 12 months. So long-term debt, well, it's not debt due over the next 12 months, but it's debt due beyond that. So it's fairly clean. It's a fairly simple explanation now that we know what debt is in general. Bonds, loans the company is taking out, anytime, let's call it interest-bearing debt where they have borrowed money and they have to pay it back. That would land under long-term debt. Then we've got deferred revenue. Now, we already saw this on the current liability side. We used the example of buying Microsoft Office at $10 a month. and, at $120 a year, but they only can account for it from a month-to-month basis. But what if you didn't pay for it for 1 year? What if you instead paid for it for the next 5 years? Well, on the non-current liability side, 4 of those next 5 years would be accounted for here. By the way, another title of this line, you might hear it called unearned revenue. Instead of deferred revenue, they might call it unearned revenue. But it's essentially the same thing. It's revenue it's money that they've already collected, so cash has gone up, but they haven't quite earned that revenue yet. So this goes up. Assets go up, liabilities go up, cash goes up, deferred revenue goes up, everything stays in balance. Deferred tax liabilities, same exact thing. Taxes that they're going to have to pay a government, but not in the next 12 months. They have a little longer than that. This number is not quite as large for Microsoft as it was for the current side, which makes sense. Generally, you pay taxes as you go. But if you see this number and there's a big jump in it, well, there's likely something that happened that they owe some government some money outside of the next 12 months. Then we've got another catch-all phrase of other long-term liabilities, other non-current liabilities. And when we look at this number, this is actually a very big number relative to the other numbers. So I dug a little into Microsoft's financial statements to see what it says. Now, this is just to illustrate of how wide-ranging of a topic this can be. So in there were a few things about some taxes, long-term taxes that they may have to do. They're under audit with the IRS, so they had to put aside some stuff for that. They're under audit as far as they made an acquisition in 2023 of Activision Blizzard. Part of that is tied up in here. Then there was some data center leases. They are leasing some different properties from different data centers, and there's some stuff in there that is tied to other non-current liabilities. So again, that's just kind of an overview of what they had. But again, it could be so many different things. So whatever company you're researching, just know it's beyond the next 12 months, and it could be a lot of different things. Read the footnotes, it'll explain it in there, and you could determine on a case-by-case basis whether or not it's something we should worry about or just kind of the normal course of business. From what I could see of Microsoft when I went back through the past few quarters, this seems like a normal course of business. They've been under audit, for example, for a long, long time with the IRS. So not too surprised. A lot of times these big companies end up in that position. Okay, then we've got capital lease obligation. Now, this one's actually kind of a cool line item that it's important that we know. First of all, if I'm using this line item, I'm adding this to debt. This is essentially long-term debt. So picture this, what companies were doing before they had to report capital lease obligations. Before they would do that, what they would do is, let's say they're going to buy a truck. They're going to buy a $100,000 truck, but instead of buying the truck, right? So if they buy the truck and they financed $100,000, so essentially they take a loan for it, well, debt has to go up. They might not want that to happen. So instead what they do would lease it, and then it would just be an expense thing. But because they're using it, let's say it's a 10-year lease, and I know that's not common with cars and trucks and stuff, but let's imagine 10-year lease, but they're essentially going to use the truck for most of its useful life. They would depreciate it. It would work just like debt. So the rules of accounting essentially accounted for that and said, you know what? Now you have to include that line item. So this is capital lease obligations are essentially debt. It's another word for debt. So if you're ever comparing a company, let's say their assets to their debt, make sure you include capital lease obligations. That's an important number to include in there because it is essentially the same exact thing as debt. Okay, then we've got total liabilities. Total liabilities is just what you think it is. Add all the lines up, including the current liabilities, and you end up with total liabilities. Well, if we were to combine total liabilities with our equity section, then that would have to equal assets. Okay, then we've got common stock. We can see that number's about $106 billion for Microsoft. And we can see each quarter it's been inching higher. Now, the way that this number goes up is if, let's say, something like stock-based compensation, or if they issue new shares, well, this number will tick higher. So if they give their employees stock options and those options get exercised, new shares get issued, this number ticks higher. Now, technically, if there's a buyback, and Microsoft does a lot of buybacks, well, if there's a stock buyback and they retire those shares, well, then this number would drop. Now, just to be clear, when a stock buyback happens, generally the stock buyback will land into treasury stock. Treasury stock it just kind of sits there and holds there. Like the shares don't do much, but they're not gone. They're still part of the overall package. So it is possible that this number tick up because, and in Microsoft's case, it's mostly because of employee stock options, but the company is also doing buybacks. But the buybacks are not hitting this line item because they're not being retired. They're going directly to treasury stock. Okay, then we've got retained earnings. Now, this is arguably one of the most important numbers on the balance sheet. After perhaps debt and cash, retained earnings tells us how much the company is retaining. So it's profit. So you take net income and basically subtract what do they pay as dividends? What do they pay for buybacks? What is remaining? It's a cumulative number. So this is not their cash position, but in theory, in time, we can kind of see it build up. It's kind of like the value of the company of what they've been able to earn after payouts to investors. So one way to look at this is early on when a company is younger, well, a younger company, this will probably be negative because maybe they're not profitable. And this number will gradually get more and more negative because you start with the previous quarter's retained earnings and then you adjust it from there. But in time, as the company becomes more mature, like a Microsoft is, well, you can end up with a chart that looks like this. But let's imagine that Microsoft, their profit kind of stalled out. Sure, it was still pretty high. They've got good profit numbers. They got good profit margins. But let's imagine it kind of stalled out, but they started paying more and more dividends. Maybe they've come up with some policy where they increase their dividends, 25% a quarter. That would be a lot, but imagine. Well, eventually dividends would be too large or stock buybacks would be too large. And now their net income is not covering it. So this number would go from growing to starting to decline. Well, that can be kind of an early warning sign that maybe things aren't all that great for this company. Now, different things can adjust at different points in time. So again, we always want to do our research with it, but this can be a good, quick number. Warren Buffett has talked about this number many times. It's a great number to get a quick look at the chart to see how, they've done over a long period of time. I like to use a 10-year chart, gives us a quick long-term view. We can see in the early years, back in 2017, their retained earnings was not that large, but in time they got profitable. They stayed profitable. They had a good payout policy. They had a good buyback policy, and these numbers have ramped up nicely. Okay, then we've got accumulated OCI. OCI is short for other comprehensive income. Now, this is a line item that it could be a few different things, but it's something that kind of skips past the income statement. So let's say there's some currency conversions that the company has lost money on. Well, that would skip past the income statement. It would go directly to accumulated other comprehensive income. It's accumulated because it builds on itself from the previous quarter. So you take the previous quarter, what adjustments need to be made, make those adjustments, that's the new number. That's why you'll generally see these numbers fairly close to each other. But again, looking at a long-term picture, we can kind of get a trend of what those numbers look like. Then we've got the catch-all other total equity. In this case, there's nothing there. But again, if there was something there, check the footnotes. Then we have total equity. Now, equity might also, a lot of times, this will be like the equivalent of book value. So if you're looking at price to book value, price to equity, it's practically the same thing. So this would be that number. Then you end up with total liabilities and equity. And again, that brings us back to the bigger picture balance sheet. With those numbers, total assets has to equal total liabilities and equities. We can see those numbers equal each other here.